Welcome to M&A Tax course by Mergerverse, and today we are going to be covering one of the most hottest topics in M&A Tax, which is reverse flip. So these are the five companies which have done reverse flip in the recent past: Pine Labs, Meesho, Zepto, Grow, and PhonePe. And of these, Pine Labs and Meesho have already been listed, and the rest are also going to get listed by soon. Now, what exactly is a reverse flip? So So all of these five companies you would note had a holding company outside India. All the investors of these companies were onboarded in those holding companies, which then invested into Indian subsidiaries. However, most of their business was in India, or all of their business was in India. Now, what they did was they merged the overseas holding company into India so that all the shareholders would become shareholders in Indian company. Now this begs the question: if you wanted to anyway merge the holding company into India, why in first place was this overseas holding company created? So there are certain reasons for creating an overseas holding company. One of the major reasons for these five companies would be that some of the investors that initially invested money in them do not directly invest into Indian companies. They have a condition that you must have a overseas company either in some jurisdiction like US or Singapore, where they will invest and not directly into an Indian company. In some other cases, there could be a scenario where the initial plan was to list on an overseas stock exchange or have multiple global business. However, realizing the potential of the Indian markets and how the success of Indian IPOs, the company later on decided that they needed to do an Indian IPO, and so decided to bring all the shareholders to India level. And third reason could be that they wanted to issue multiple kinds of instruments, and it would not have been possible to issue in India due to FEMA and Companies Act restrictions, which we'll cover separately. And so they decided to incorporate a foreign holding company, and then once the valuations are settled, they decide to merge into Indian company. Why do they want to reverse flip now when they had a foreign holding company? And the main answer, or the simple answer in most cases, is because they want to do an IPO in India. And this is basically what we are seeing with so many successful IPOs being held. In 2025 alone, we have seen the IPO of Meesho very recently, and before that also multiple IPOs have come in India. So this is the main reason why most of them companies are trying to do reverse flip. So what is the ways of doing reverse flip? So in most cases, and most common way is merger, and merger is the preferred way because it is the tax efficient manner. So if you will go and see the scheme of any of these companies, they did a merger. You can download the scheme of Pine Labs. They will show it was a merger of a Singapore holding company into an Indian company, and in that merger, there would be no tax liability arising in India because merger would be tax neutral under Section 49, or rather, it will not be considered as a transfer. But not all jurisdictions allow cross-border mergers. So there are some countries like UK, for example, which does not allow merger of a UK company with a foreign company. So in that case, the another possibility would be the liquidation of that holding company and transferring shares of that company to the shareholders. Sorry, the transferring the investment in Indian company held by those shareholders to the shareholders of the UK company. So, for example, the UK company holds shares of an Indian company. Now we liquidate the UK company, and the shareholders would gain shares in Indian company on the shares held in the UK company. Now liquidation could result in tax liability in India if there are gains on liquidation, and if there could be deemed dividend implication if the UK company had profits or accumulated reserves. And the third option could be a share swap, which is the holding company, overseas holding company, buys back the shares of from the shareholder and in return gives its investment in the Indian company. Again, uh, this will also result in tax liability in hands of shareholders and also in the hands of company, or And we have covered direct and indirect transfer in a separate video, so there could be treaty benefit for investors, but in the third option there could be tax liability in the hands of the company as well, if it does not have treaty benefit as well. So before we leave, I would want you to download a scheme of arrangement for merger of any of the five companies in the first slide. I think PhonePe did not do merger, but apart from that, you can download any one of those and go through that scheme of arrangement and find out any details or anything that you find interesting. So thanks for watching.